that anyone and everyone should be looking for should be at least 51% winning ratio strategy. And this strategy, depending on the time that I'm using, gives me between 65 to 78% win ratio. Divergence is a disagreement with the price and the indicator or oscillator that you are using. So this is really what divergence means for me, and you should try to understand it from that perspective. As an example, when you are looking into the market and you see that the market is making basically a low, and the market is clearly in a bearish trend, like in this scenario, and you see that your RSI is making a higher high. So while the market is going down, RSI starts going upwards. So it's a signal for you to understand, or kind of like a hidden message from the market for you, that look, there is a possibility that I'm going to be reversing. But the question is, when is that possibility? And how do you determine the right time to enter to the market so that you are not burned by the price action into the wrong side? Because as an example, in this scenario, we were looking for bearish market, everything is clearly bearish, and just RSI is telling us, look, I'm possibly gonna be going upwards, so the market should be possibly going upwards as well. So when do we really enter bullish? That's the golden question. This is what we are going to be answering today. Based on the divergence theory, there are two types of divergences. One is the classic divergence that everyone is using, and the other one is the hidden divergence, which most of the people don't really understand how it works, and they act as if they understand, and they end up, of course, burning themselves. Divergences are often used in RSI, CCI, and MACD, as well as on stochastic as well. So as Murphy commented, they are basically giving you the disagreement between the price action and the oscillator or indicator that you are using for. And let's first look at the classic divergence that most of you guys are aware of. Basically, what classic divergence says is that, imagining that the market is moving on a bearish trend, like over here, where you see that the trend is clearly going down, and you see that possibly your RSI or MACD, whichever indicator that you are using, is making a higher low. So if you combine the bottom of it, like over here and over here, you see a higher low. Meanwhile, the price action was giving you a lower low. In such scenario, you should be looking for trend reversal on the bullish side. Or in an alternative opposite way, when the market is making a higher high, like this high, one is higher than the two, and additionally your moving average, your oscillator MACD or RSI is giving you a lower high, like alternative 3 and 4 over here. In such case, you should be looking for potential reversal into the bearish side. But the question is, when do we really understand that the market is really into the reversal? Because often we will be seeing that the market is kind of reversing, but it wouldn't be really reversing. I mean, just the RSI or MACD, etc., would be giving us a fake divergences, or our eyes would be lying to us. The latter would be the often case, that we tend to see the things that doesn't really exist. Yeah, and don't blame yourself. We are all human and we are all programmed to make mistakes. The thing is, we need to take the best advantage of these things and be able to take advantage of the fake breakouts, fake divergences, and differentiate between a classic divergence and a hidden divergence. Basically, the classic divergence is looking for reversals, while the hidden divergence is looking for continuation. So how does really that work? So if you are looking for a hidden divergence, basically you are expected to look for, let's say the market is going into the bullish development, like over here. Yeah, you see that clearly the market has gone into the bullish trend because of the fact that you have a higher high and higher low on the price action, while you see your RSI or MACD giving you a lower low. In such case, you don't say that, wait a minute, I just want to sell. You need to understand that price action is the king. So it's the best way for you to take the price action into your hands. Alternatively, into the bearish scenario as well, when you see that the price action is giving you lower highs and lower lows, and you see your RSI is giving you a higher high, that doesn't mean for you to go against the trend, because again, divergences can be hidden or fake. In such case, you need to first weigh most pressure on your price action, because price action is the king. It tells you everything that you need about the market. Today's webinar, by the way, is delivered to you by Super Trading Online and A to Z Forex, and you see the platform of AFX or Super Trading Online. In here, what I show in my strategies all the time is the simplicity. Okay, there are so many ways for me to be able to demonstrate you a strategy. I can add multiple moving averages, I can add multiple trend lines, etc. But quite often we really don't need any of them. And quite often we just need one indicator, and I always need a moving average. I can't trade without moving average myself. So let's just go backwards and try to see a clear bearish market, like over here. Okay, this is daily time frame, euro dollar, and we see that the market is clearly on bearish trend. No one can doubt it. How do we see that the market is clearly on bearish trend? It's very simple. Okay, you don't see the trend direction by just looking at it and say that, okay, it shows downwards, although it's one way. But the best way for you to be able to define whether the market is into a bearish mode or bullish mode is looking at its lows and see whether they are making a lower lows, and also into its highs and see whether or not they are making a lower highs. If such scenario is the case, then you are into the bearish market development. So this is the daily time frame, and we are looking into euro dollar, and we can see that despite the fact that the market is bearish over here, we can see that there is over here, I hope that you can see what I'm trying to show you. There is over here a divergence occurring, giving you the signal that, wait a minute, traders, I'm gonna be entering into the bullish potential reversal. And how is that? So the level that I'm showing you, by the way, is over here. So if you are looking at it, although it's not the best highs, etc., that I can show, but if you are looking at it, you will see that it's a very clear divergence. While the market is going downwards, RSI is giving us a bullish divergence. So when do we really use that divergence? How do we really use that divergence? The answer is pretty simple. Moving average. If you participated in my moving average training before, I always tell you, look at the direction of the moving average. Is your moving average showing up or not? Is your moving average showing flat or not? Or whether maybe it's showing downwards. So the direction of your moving average that you are going to be utilizing on a specific scenario will be giving you the direction of the trend. So in such a scenario over here, when we are looking at it, we need to look for the confirmation of the divergence, which is basically the RSI as an example should not be below the trend line that we draw on the RSI. And moving average, because RSI is giving us a bullish divergence, so the moving average needs to start being flat or better to be upwards. And how do we really trade that is the main question. So the market needs to, I hope that you are writing it down, by the way, the market needs to close above the moving average. And when the market is closing above the moving average, the direction of the moving average needs to show upwards. So which level that you would be trading over here? Let me just so I'm gonna make a different color over here. This is gonna be green. So which level would you be trading over here? And why? So I see a lot of answers from you guys, but remember the one thing that I told you, price action is the key. So when we are into a clear bearish market, we need to see a price action confirming that the trend has reversed, okay? It's not just the moving average. It's not just the RSI. It needs to be a KPI, key performance indicators that all meet. As an example, for this strategy, one KPI is that we need to have a bullish divergence. This is met. So one is check mark, done. Secondly, we need to see moving average starting showing upwards. So we have the case over here, 1, and the case over here, 2. So moving average starts to turn upwards. That's check as well, correct? The third KPI is the price action, which needs to show us that there is a higher high and higher low. It cannot be just higher low and lower high. It needs to be, well, both of them needs to be met. So for such case, if we really look into this carefully, we can see that the first level over here is not a price action. So we have a higher low, but it's not giving us a higher high as well, because the previous high was higher than this one. So clearly the first level that we have is not really the entry level. Let's look into the second one. So we see that the market really went up and then made a higher low and then made a lower high. But if we look into this high, and we can see that basically comparing it to the previous main low, we can see that the market still made a higher low. And what we need is to see whether or not the market is going to be making another higher high. So what is our highest high over here? The middle line. So middle line needs to be broken above in order for us to consider bullish development. So RSI is check, moving average is check, and price action is check. Therefore the middle level, well, I drew it a little too low, but this level is the main level that you should be considering in order for you to trade on the bullish side. And that would be basically the case for you, that you can enter at that level and it's pretty much risk-free trading for you. And the next question becomes, where do we target? The next target for you, because you enter at the breakout, of course needs to be to the next, well, price action as well. So you look for the market to give you a resistance level for you to be able to exit. So the next resistance that you see clearly in front of you, well, I'll delete the middle, these levels. So the next level that you see clearly in front of you that you have clear support / resistance is the following level. So you enter over here. So your entry would have been at 1.1067 and you should be exiting at the following resistance at 1.1268 level. It gives you pretty much 200 pips, and this is on daily time frame without really worrying about anything. Now let's look into the hourly time frame that we were discussing before, like today. or last week overall. So what do we look for and how do we trade these divergences? We first, KPI perspective, we first look for the bullish divergence on RSI, which we have. We see the moving average changing its direction, which is check as well. And the next level that we need to look for is a higher high and higher low. So the market went down. We had a low over here, and we had this high. The following low over here was higher than the previous low. So first higher low that we see is at this given level. And the next one that we need to have as a confirmation is this level. So we basically look for the middle line, not to the first, not to the second, but the middle line to be broken above for you to be able to long the pair. So what you do is that you go from here and your target is the following resistance. Your following resistance is somewhere at this level. Well, there it is. So you should have entered that there with 70 pips of take profit, and you would have been done. So this is another example. Let's go back and see one more example. Again, the market is in bearish development. We have intraday lower highs and lower lows, and RSI is giving us a higher high, bullish divergence, check. And what do? We look for the moving average to start changing its direction. So it's done over here, and we need to see a price action change as well. So what is price action? We need to see a higher high and higher low. So this low over here is higher than the previous one, and this high over here is higher than the previous one as well. So we enter somewhere at this level, and again we use our take profit to the following level, well, which is 120 pips. And you can see that it triggers. The second it anyway touches it, you would be seeing the market really giving you some kind of well, sideways development, like over here you can see over this level. It starts giving you shaky market move. So to answer the questions once again, the moving average we use is going to be 20 simple moving average applied to close, and RSI we use is going to be the 14 period RSI applied to median, and it's just like as is over here. Why do you use 50, 30 and 70 levels on RSI? Well, for me, I believe that in order for me to consider bullish entries, I need to see my RSI above 50. In order for me to see the bearish entries, I need to see my RSI below 50. And if the RSI is touching the 70 level, I try to basically look for another touch to 50 level before I enter another bullish entry as well. So that's the main reason I have the 70 level. The 30 level is just the opposite way. If RSI is touching the 30 level, I look for RSI to touch the 50 level or 70 level the opposite way in order for me to consider the bearish entry. You can see perfectly a great example over here. You see that RSI touching to the 30 level. What you see or what you need is afterwards to have or to wait for the 70 level to be touched. So this is the level, and then you just short, and that's gonna be it basically. Which time frames are the main time frames for this strategy? This is another great question. Well, I only trade myself on daily time frame and hourly time frame, so I highly recommend you to trade on daily and hourly as well. But you are of course more than welcome to test it on any other time frames. However, you have to bear in mind that since this strategy is also based on price action, you need to follow, or you cannot just trade on 5-minute chart or 15-minute or 30-minute chart. It doesn't give you the price action on those time frames. And if you are using the stop loss, this strategy is mostly based on price action. Again, you need to find your previous stop or previous support if you are buying in order to put your stop loss just below it, and if you are selling, you need to find your previous resistance and put your stop just above it. So it's not fixed like you use 30 pips or 50 pips. Sometimes you're going to be using 15 pips, sometimes you're going to be using 90 pips. You need to use the proper risk management in order for you to define the levels that you need to look for. And in general, I don't believe in risk reward ratio. Sometimes I would even use 1 to 0.5 risk reward ratio. So I'm not one of those guys who tells you that you need to have 1 to 1 or 1 to 5 risk reward ratio. And if you haven't watched my risk reward ratio is not everything webinar, go on a2zforex.com and type risk reward ratio is not everything and watch that video there. Because if you follow it, you will see that the logic behind why I don't really care about risk reward ratio. You can add any other basically strategies, any other, or you can even combine with other indicators and so on that you have. But for me, I don't believe in complexity. I believe in simplicity. So that's the main reason why I don't add a bunch of other indicators here. I could add, if I am to add anything here, that would be for me probably on weekly time frame. I would add potentially Fibonacci, because that would be giving me a better potential outlook for the market to see where my stop and take profit levels should be at. That's the only additional thing that I would use with this strategy myself. But you are more than welcome to test it on any other pairs. That's another question, which pairs you should be using. I use it only with the USD pairs. So any pair that has USD in it, I wouldn't hesitate using it. And I also quite often be using this strategy with the commodities as well, where you use and you see great results with the commodities too, with this strategy. Today's webinar was delivered to you by A2Z Forex and sponsored by Super Trading Online. They are one of the A2Z approved brokers. I highly recommend them myself. And one thing that kind of stands out for me at the moment is their 10% annual interest campaign, which means that if you deposit with them, of course, based on their terms and conditions, your account automatically grows by 10% per year.